Welcome to the PJ Finance Show. Currency determinants and its impact on stock market.
Among the various determinants of currency fluctuations, we will discuss how interest rates fluctuate, how it affects the stock market, and the effect on the economy.
The stock market and the currency, forex market are both driven by each
interest rates differentials. It is important to understand how the money will flow. Money from country A will flow to country B, if the rate of interest is lower in country B.
Talking more about the factors that affect the fluctuation. It can be seen that it can affect the cost of imports and exports.
If we generalize, a country that is more competitive in global trade will have more exports than imports. Consequently, its currency will be stronger because it has more dollars to sell, since most global trades are denominated in US dollars. The main factor that affects the stock market is the cost to the company. When the imports go down, the cost of the company goes down. And when the exports rise up, the profits go up, having a positive effect on the stock market.
Weak dollar leads to an increase in the competitiveness in the U.S. exports market. Such fluctuations have an impact on specific sectors of the market. In this case, the recommended stocks will be from the energy sector and raw material sector, as the U.S. is an exporter of these products. A strong dollar will lead to a flow of foreign investments into the U.S. market, leading to a jump in the GDP. As exports will be down, the sectors the investor should consider investing in will be consumer goods, utilities, and real estate.
The main goal of the currency risk mitigation strategy is to minimize or eliminate economic exposure through hedging. Some of the currency risk mitigation strategies are: matching currency flows. A company matches the foreign currency outflows with foreign currency inflows. Currency risk sharing agreements. A company enters into a currency risk sharing agreement with its supplier/customer. According to this agreement, the sale/purchase contract is executed at a predetermined price. Thus, both parties share the potential currency risk. Currency swaps. A company can use currency swaps to obtain the required cash flows in foreign currency at the desired exchange rate. The counterparties will exchange the interest and principal in one currency for the same in another currency at fixed dates until the maturity of the swap.
Takeaways. The relationship between USD and the commodity market is inverse. Net exports have an inverse relationship with the strength of the domestic currency.
Thank you for watching Currency Determinants and its impacts on stock market.